Today, my guest is Dan Kryzanowski. He's an active capital raiser, equity owner, and passive investor, generating double-digit yields and lower taxes via commercial real estate. Dan, which is why we had him on the show today, is an expert in self-directed accounts, including solo 401ks, self-directed IRAs, and this is what we got in today. And so if you are trying to figure out how do you get access to secret capital that you didn't realize that you could access now, Dan's going to talk about that. So how you can get better returns on these funds or on these accounts that maybe traditionally or typically you wouldn't have access to. I think you're going to really enjoy the show with Dan. I know I did. Let's get into it. Dan, welcome to the show, man. What's up?
Doing great, brother. Doing great.
Guys, we got a special guest on, active capital raiser, equity owner, investor. Man, you've been around the space for a while. Got a lot to jump into today. We're going to talk a lot about self-directed investing and just kind of how the space is moving. You know, I find it interesting, Dan. Like, that's why I love having you on, man, and starting the show, because where else do you go to learn this stuff?
Yeah, they don't teach it at school.
Because it wasn't even in school when we were in school. Like, this space has moved so fast in terms of crowdfunding and the alternative investments that have been accessible. It wasn't even,
Well, you're right. I mean, crowdfunding wasn't, and first of all, shout out to our fellow Pikes, Pi Kappa Alpha fraternity.
There we go. Yeah, absolutely.
But, you can see my gray hair on both sides here, not that much hair.
I'm glad you made that connection. I totally forgot about that. That's awesome.
And, we had quite a time. I joke, self-directed IRA is a little nerdy, not really heard of, but when you get to know about them, you really like them, kind of like myself. And, I'll do a little snobbery, me going to my undergrad at Wharton, it never even came up. And I did a fair amount of obviously finance class, investing classes, rolled off on Wall Street where everybody thinks they know the biggest, greatest. Fast forward, even as crowdfunding was being formed before it was, the concept of using an SDI IRA was not mainstream. And it took me a little while, but I think I finally figured out, up until a few years ago, it wasn't what I called country club cool. To tell everybody like, hey, you should do this, or you're going to invest in my next 4 deals, 25K a pop. Use one of these self-directed accounts because, a lot of paperwork, you need a scanner, a fax machine, and God forbid you made a good investment, you're paying more per asset or per transaction. I mean, good news is that's all by the wayside right now. But historically, I think that's honestly what it was. Like anything, when it wasn't smooth and easy, people don't want to talk about it. And now it's becoming not fully mainstream, but in enough of our pockets, I think it's becoming mainstream.
Explain the difference between, let's just start there, man, self-directed and just investing. Like, I mean, is it in some way everything self-directed? So, I mean, explain where the name comes from and what is advantageous about self-directed investing.
Yeah, I'll kind of define. First of all, self-directed, capital S, capital D, it's like Scooby-Doo, boom, big and bold. Because a lot of folks say, yeah, I self-direct, meaning I have my 401k at my W2J job, or I have a rollover IRA in Fidelity. Yes, with lowercase letters, you are self-directing into a handful of funds probably, and that's it. Now, separately, if you want a self-directed account, once again, capital S, capital D, because it is also a legal term, this is where you take back control of your retirement dollars to invest in what you want, when you want. So it truly is, best analogy I could say is, my 5-year-old was studying, of course, dinosaurs, stars, you name it. I like to think of the lowercase, or kind of what you're limited to in a Fidelity Vanguard, as, a star, whereas a self-directed world that we know is basically like the galaxy. I mean, it's huge. It's effectively limitless with a few minor exceptions of what you can invest in.
Well, let me ask you this. I've seen some things kind of in legislation, and we don't have to get into this too much, but do you worry that maybe with policies and stuff that we're trying to cut into that self-directed, or where do you see the kind of the future of this space, self-directing? You see it continue to be something that will grow in size and popularity, or do you think that, the government wants to continue to get its hands in it and that it becomes a shrinking space?
I think it's going to continue to expand. So first of all, I want to give you, I know we got right into it there, a shout out at IIREC in SoCal. The panels were awesome, especially this Saturday. And I've told many friends, from sitting in the audience alone, it's worth $1. And of course,
Yeah.
the tremendous networking we had. No. So once again, I mean, a lot of politicians have these accounts. What surprised me, frankly, is I didn't really see the political gains on either side of the aisle to say, hey, we're going to shut down some of these accounts. Because in the big picture, it's not a huge, it's still 1-2% of all the retirement dollars out there. And then secondly, one of the recent headlines, I think it was a court case. This is just somebody in the space, and he took liberties with I'd say a myopic headline on a ruling on something with Google Rand or something in gold, which is frankly a very small percentage of what folks have these self-directed accounts for, which is frankly passive real estate or to own a second house, own a rental house. So yes, will people take liberties? Yes, and in some ways, I think that proves that this is going to grow. It's going to continue to support. And final point, if you're a politician now and you say, hey, the days of the 60-40 stock bond, when somebody's making 0, 1, 2, 3% of their bonds and inflation 7, you don't want to be the politician saying, oh, by the way, the chance for your 6 to 8% multifamily or storage or whatever real estate and 15 IRR, we're not going to give you access to that anymore. You're not going to get many votes. So I actually see it. And final point, I'd say, your generation, folks coming up and coming, they're naturally growing up with crowdfunding. This is just a separate bucket of money for them. So I think it's going to be pretty easy, and you're going to see that the pie is going to start to grow a little bit more.
One of the things I think is still misunderstood is just how easy it is to transfer over to a self-directed IRA. So if someone's listening to this and like, yeah, I'd like to maybe get into some of these alternative assets, like a real estate syndication, for example. I mean, how easy is it to take what you've maybe traditionally been putting money into and turning that into some type of self-directed asset?
It's really easy. And I'll use my personal situation. I worked for General Electric, and I think we had Voya or somebody at the time. That was my 401k. I left GE, so it gets moved into Fidelity. It's called a rollover IRA. Still limited, of course, what I can go into. That said, we're still pre-tax, still traditional. There's no taxes, there's no penalties, there's no fees. And then I move into a self-directed account, which is a self-directed IRA or solo 401k. It's just another stop on the train right now. The big difference, once again, is now I have, with the exception of life insurance collectibles or myself or my linear family, meaning a house for me, my kid's startup, beach house for my parents, everything else is in play that you can use. In terms of the sign up, the likes of a Rocket Dollar that I have association with, we made it as seamless as possible, as legally possible to sign up for one of these accounts. It's like anything else you'll see in the fintech world. 5 minutes, you e-sign a few things back and forth, fill out a form with your Fidelity, et cetera. Money moves to the checkbook portion, which is an FDIC insured account. And then from here, much like you could with your piggy bank checking account, you can invest in what you want, when you want, at any time.
Is Rocket Dollar have a custodian involved or no?
Yeah, there is. So there's 2 types of accounts. The solo 401k by definition, by default, does not have a custodian. The IRA does, especially I'd say for any non-Californian W-2 folks out here. The checkbook control, the IRA LLC model is how it's done, but there's various custodians in the background. So in short, yes, there's a custodian on there.
So tell me, so let's walk through some strategies, man. Like I want to hear some real stories of, you're raising capital, you have an investor network, you're an investor yourself. I mean, just some real life applications and kind of the goal is financial freedom. Let's not lose sight, right, of what we're talking about here. And this is only accelerating that. So let's talk through some scenarios or even some stories of ways you've helped your investors do this and how others might consider as well.
Yeah, so a real example, and kind of going full circle, I got to know everybody in self-storage. Gentleman who I felt was the top operator in the space went on his own about 6 years ago. Gentleman John Manus, Pinnacle Storage. On a regular basis, John would inform his, started off his friends who became investors, that they can use their retirement dollars to invest in this deal and his next deal. He could have done it in the past deal. It's just one line. He didn't go into deep detail. He didn't have to be the expert, but by, on the equivalent of his monthly newsletters or in each of his deals, that one line say, hey, did you know you can use your retirement dollars? By doing that, John and I know many others, they fill up their raise with 10 to 20% of self-directed dollars. I joke, you get to take Friday off because you got this done. And the true feel-good story of this is, let's just say we have a buddy here, gentleman in his older 50s, just retired, but his 3 kids are at USC. That's going to hurt the pocketbook, the liquid pocketbook in a little bit. But you have this $1 million 401k. Ellis, he might really want to invest in one of your deals. This is his only pocket of money. when he becomes made aware of it, he's going to be ecstatic that he's pulling out of his, target date year 2050 fund and can invest with you.
Right.
So the main thing is just sharing that one line over and over. And listen, there's many folks, custodians, there's up and comers like Rockefeller on the street, but just making that piece of education aware, because you are going to see folks, or they double down. They realize, hey, I have 30,000 in a random Roth somewhere. Can I do something with that? It's like, should I already put 100? Come on in.
Well, it's super advantageous, right, when it comes to real estate, because one, all that the cash flow is going back into your IRA account. So, you're not getting hit with kind of the income tax that you typically would if you were investing this with normal dollars. And then it kind of eliminates the need to 1031, because those proceeds come back, and then you can now tell me if I'm wrong in that, but the way I see it and understand how that works, I'm like, it really is advantageous to invest in these accounts, because a lot of the reasons maybe why you want to keep money working in real estate, it just gives more flexibility. And that's why I tell my investors, if you have that, I'm like, man, it's kind of a no-brainer in my opinion.
Let's assume, one of the 1.3 million realtors is listening to us today. They're 1099. My guess is, you had a pretty good year, or will have a pretty good year, even if you just sell a few houses here. Much like your W-2 buddies, in a self-directed solo 401k, you can contribute the 19.5. In addition, 20% of your net earnings. Simple math, a realtor makes 100K, he or she can put away 39.5 right off the bat. So once again, by this equation, depending if you're married, a husband-wife team, if you're over 50, you can be looking at 50-60, husband-wife team, you can be looking at in the 110s, 120 range, that you're lowering your AGI this year to contribute, which is separate than anything you might transfer or roll over. And then once again, can't benefit yourself, can't be your own house, can't be your own company, but then you can invest passively, either something you're interested in. Hey, I want to get to know storage. I want to get to know Texas industrial. Ellis is a really good dude. I might want to do some other business. And I always bring it back to, like, this analogy holds true between like and trust. You and I can like each other a million times over on Facebook. At a certain point, trust is when the money moves. And the self-directed IRA gives folks the opportunity, once again, as I say, Nike, just do it,
Yeah.
to kind of exhibit that trust mutually, because.
Well, to hone in what you just said there, so you're saying they're lowering their income tax because that money's coming out pre-tax, right? Into the 401k.
Mm-hmm.
So you're lowering your tax liability from an income standpoint. If you're a real estate agent, then you're able to take that money and essentially grow it tax-free into an appreciating cash flowing asset, and you're not really paying the taxes on it. The question, though, then becomes, Dan, I guess, and some of this stuff is thinking about this for your clients, your investors. What are the things, I guess, in the future that they should really be considering then in terms of kind of the liability coming ahead when they're ready to actually live off this money?
Yeah, once again, I'll caveat, I am licensed under BB Capital Series 7, so this is not, financial advice. And let's just talk as investors or somebody, like to say the over 40 crowd. You probably work corporate. This is your IRA. You just want to have the ability to expand what you could invest in. The nice thing, much like folks that have been W-2 their whole life, you're not paying taxes, you're not paying capital gains losses as you're in and out. And then ultimately, round numbers, say you contributed 100K and it's 150K. As you take that out, you're going to pay taxes on the 150K as you take it out. This is kind of, let's say, my parents' generation, what they did.
Mm-hmm.
Same deal here. So I guess, are you going to benefit from depreciation? Not really, no. Flip side, you invest in a startup, it goes to zero. Are you going to get the capital gains loss? You have, and I know we've a lot of these multifamily deals, go 2x in a year. Are you paying a big tax on that? Or have to worry about 1031? No.
Right.
You're in this protected zone. The final point I'll make, and all the headlines on Figure Field last year taking whatever 50K to 5 billion. The whole seed, you'll get this. I'm sure you probably preached on it before. The seed versus the tree analogy. I'd much rather pay taxes on a relatively small seed, do a Roth conversion, invest with people I trust, and then fast forward in my 60s, 70s, call it that 100K turns into $1 million. I'd rather pay taxes on that 100K today than $1 million in the future. I
want to kind of transition and just get your outlook on where we're at in terms of the real estate market, what you've been focused on from an investor and raising capital, and into kind of what's maybe changing in 2022 and why. We talked a little bit offline, but I'd love to kind of bring that online and just hear, as you're kind of growing and hearing, where are you focused, man? What's changing? What have you been focused on, and what's changing in 2022?
Yeah, so I've obviously been involved in storage for the past decade. I'm still bullish on it. I mean, listen, 4 to 5 uh, storage facilities are still owned by mom and pops, grandma, grandpas. If you're, I'd say, sophisticated owner operator, there's still a lot of meat on the bone. Obviously, the tough thing is finding these properties. Storage is pretty unregulated. Sometimes it's tough to find the owner. When you do, there's some pretty good upsides. So storage is still a business you can outwork somebody. If you've been around the sun about 18 months in it, you can be pretty profitable. So I like to look at secondary, tertiary markets, downtown MSAs. Public storage is going to buy at a 4 and change cap. Good luck. You can't compete with that.
Right.
Secondly, I love industrial. I mean, just as we've experienced through COVID, the whole last mile industrial, Amazon warehouse, the delays at ports, the importance of having your stuff there, not to mention your typical industrial park or whatever. I'm a big fan of single property, triple net lease, especially when you have a long-term lease, it's cash flowing versus call it a fund or a portfolio that might be 3 to 5 years. I mean, effectively it's a bond. You're probably getting the equivalent of 5 to 10x any sort of AAA corporate bond you can get out there. Really, really like that. A little more on a personal note, what I've seen, once again, this is to get your take, kind of how you look at it. For better or worse, I still think there's a lot of upside in residential. Your backyard, I read a great New York Times article in San Diego where a couple in 2019 thought they can buy, big money comes in, says, well, no, we're going to outbid you. We're going to put up an AB and ADU, and we're going to jack up the price so you can only rent one of them. So it's a sort of cycle, and not to say, I get it, we're not a capitalist country, but unconsciously I felt there's an unwritten rule where residential is kind of sacred a little bit. You're not going to get big money into it. And, either big money is in hobbyists and I'd say other large buckets of money that aren't the typical buckets that control whether you buy Coke or Pepsi, Gap or Levi's, etc. Where much like anything, if folks are trading together higher dollar amounts, it just ups the ante for somebody to get in for something as simple as a starter house. So,
Right.
You can argue for how that's going to play out from a societal, but from an economic standpoint, especially with 40% more cash pumped into the market, I just don't see how there's not. Going back to Maslow's hierarchy of needs, shelter is you have air, water, food, shelter. I think people are realizing that post-COVID, and wow, my house, this is a good asset. I spend a lot of time here, etc. As I said, there's different effects on society, but from a black and white investment perspective, much like people say storage, we're at an equilibrium. I think residential, there's still a lot of upside.
Residential in terms of like single family homes, or would you include multifamily commercial into that same thesis?
I would say it's separate from the standpoint, because I look multifamily more from an owner. I know there's built to rent, sort of different communities, but
Right.
yes, multifamily. I always view it. I said you have your food and water on the flip side, and then you have, I'd say, the rent rates you're used to paying, call it in 2019. Obviously, there's taxes on the back, and more for you guys in California than not in Texas. And then you have this nice little thing to go on vacation, save. If you own a building and somebody says, "Hey, I want to live in," I know it's not sunny today, but it's a beautiful neighborhood in Austin because my kids can walk to school, and I'm going to raise your rate 50%. You know what? Or say the house price is going to go up 40%. Well, I might want to stay in the school district, so I'm probably going to do it. And then fast forward 5 or 10 years, let's say if I'm an owner, well, I'm going to keep on selling at this sort of high price because somebody else is going to want this. And from a rent standpoint, I might say, yeah, I really want my kid to go to this school. Well, I wish I could be saving. Can't. But what are you going to do? So I think, and I don't think we're going to hit like a societal boiling point. It's just going to be very uncomfortable for a lot of people. But, that's how I think economics are going to play out.
In terms of your portfolio allocation, how much is real estate and how much are other alternative assets?
Yeah, so in my cap table, I'm looking at all the bricks behind you. It's kind of like all the bricks all over the place. It's probably, I'd say 60% to 2/3 real estate.
Okay.
Obviously, I like to say we eat our own dog food. So BV Capital, we're in a variety of whether it's workforce housing, student housing here in Texas, triple net industrial, the whole Lichen Trust. I'm putting my money. I trust industrial. I just had a lot of storage go round trip, so I'm replacing some of that. Have a good buddy close to where you went to school in the Carolinas. Never missed out on a payment, hard money lender to single family housing. Separately, the startups I've been in, yes, one in real estate tech went to zero, not because of the team or the tech. It's just one of the 3 founders moved on, normal. The other one got hit with cancer. It's a tough putt to do 3 jobs at once. Separately, I've seen my other startups grow at the equivalent of 1x a year, which is always nice. And then finally, I found it very beneficial, once again, head and heart, to do loans with female entrepreneurs and folks, as they say, on the other side of the tracks. So I as nice as it is for a little donation or a like on LinkedIn, even if it's 5K, 10K, that can kickstart a business, kickstart it, and that money gets recycled in this micro community. So for me, and I said, this is investing. This is all double-digit returns. I'm not doing this out of college.
Right. Yeah.
But I think it's a wise investment too. So that is and there's a few, gentlemen in your neck of the woods of biotech. And then a final thing, politics way aside, natural disasters will continue on the planet. And I think instead of, say, an old 20-foot metal TEU container that finally gets there, it's the future of disaster recovery. Like anything, a servant's mind, I do about 50 mentor calls a year with different startups. And sometimes, hey, it makes sense to drop a chip.
Interesting. Let me ask you the last question, man, is you live in Austin. A lot's happened there. Austin's been in the news. I mean, talk to me about the future of Austin. Like, do you see it kind of taking control of kind of becoming the tech hub of the United States and how rapidly, I mean, we've seen Tesla, we've seen Samsung. Does it really got some legs, man? Talk to me about the future of Austin.
I think when you talk Austin, you talk city limits, you talk the MSA, you talk, I'll call it the Metroplex from San Antonio, I'll call it the mushroom kind of surrounding Austin and going north almost up to Waco, and then Texas in general. And I won't go into detail on each, but I do think you have to look at it in each one. Austin has only 2 areas where towers can be built, downtown and the northwest where our soccer team is now. My neighborhood behind me here, you can't really build up. This is like a mini San Francisco in terms of zoning because of what's under the ground, actually. West of Mopac, which parallels our highway, you can't build up for certain reasons. So with all that said, unlike a Dallas, where I think Dallas does a great job of going out and up, if people need to be downtown, boys, it's going to make California traffic look like a breeze in 10 years. And obviously, we claim the live music capital of the world. That's gone away. The weirdness, I think, started to evaporate about a decade ago. But it's maturation. So, if Austin turned into a Nashville, I think that'd be a great scenario. There's some other West Coast cities that it's not as great. That said, in terms of the weather's pretty good. I joke we have a Truman Show bubble for any of the major stuff that has hit Houston or the crazy power outage aside last year, the stuff that hits Dallas and by the oil belt. But yeah, I mean, it's a business-friendly state. I still think you can have a raging liberal, raging conservative, still kind of get along on most topics for most things during the day. You don't see that in other parts of the country. So socially, it's still kind of okay, but you can do your own thing. And frankly, there's space. I mean, there's a lot of space and a lot of folks, if you don't, kind of need or want that, I'll call that New York City walkability. You don't mind a little bit. There's a lot out there. So I think Texas has always had the foresight. I'll take UT Austin. I mean, we didn't have a medical school at UT till a few years ago. They were all spread out across the state. I mean, tech aside, that brings all sorts of jobs. So I think there's other things where there has not been one of these in Austin yet or in the Metroplex that will come here over time. So I think there's a lot of growth. What I would say, the infrastructure may not be there as maybe say how California was planned so many years ago. So you might have natural pauses because frankly, it's not that easy to plug in when you're so spread out. So that would just be one caution for somebody blinded here. And once again, culturally, it's still Texas. Once again, crazy employer friendly, non-employee. There's still a lot of good old boy that goes around here that you have to learn the lingo even if you can't speak it. So but that said, yeah, net it's a pretty good place.
You're from there or no?
No, I mean I grew up in Scranton, PA.
Oh, that's right. You said yes, sir. I saw that.
I mean, the first weekend I was here was the weekend before 9/11. I remember going a mile on the east side, flying back to LaGuardia with a big Emo pinata after we had kerosene buckets of who knows what oil dropping turkeys. And now that's old Austin 20 years ago. Even 10, 15 years ago, we I mean that's just long gone. Let's put it that way.
Yeah. Dan, this has been super enjoyable, man. I want folks to kind of, I mean, I'm sure after hearing this, I love your detailed approach to almost every topic. Where to BV Capital, tell us a little bit more about that and where folks can go to follow along, man.
Yeah, absolutely. So, I mean, bvcapitaltx.com is a great website to see. I always like to talk one-on-one, like, I think there's great impact. So, LinkedIn is great. I'm pretty religious on it. There's not too many Dan Kryzanowskis. Find me, say, you heard Ellis and Dan talking. I think on the IRA side, the self-directed side, rocketdollar.com/learn, 2 a.m. It's an award-winning knowledge base. You can self-educate. And just as a final thank you, I like to joke, if you can spell it, you can get it. D. Kryzanowski, it's 12 letters. That'll get you a few.
But I think that's a really good movement. I appreciate your insight on self-directed. I learned a ton, even though we have a lot of self-directed investors in our stuff. It's always good to kind of hear from someone who's an expert in it. So, man, I appreciate you. I'm excited to see you in Austin here in just a couple of weeks, and looking forward to doing some business together in the future.
Awesome, brother. Make it
All right, man.